Thank you very much for tuning in. We'll get through this presentation in a minute. Thank you, Tracy. Okay. Well, first of all, I'd like to welcome everybody to this webinar with XTB. My name is Walid Kudmani. I am the XTB market analyst in XTB UK for the Italian, Arabic, and UK markets. And today we will be talking about a few very relevant topics. So those include obviously what's happening in the markets, what's happening in the broader economy, news, a few charts, perhaps a few stocks that haven't been performing to the same extent as the broad indices. And then I will transition into the oil market, how all of this is playing into the oil market, and then just a bit of a conclusion. Perhaps we'll give a quick look at the platform and see if something is going on at the moment. Before we start, I'd like to just remind you all that this is information for research based on and it's not investment advice. So just take it at your own risk. And if we're ready to start, we can start. So this presentation is provided for general information and marketing purposes only. Please be aware that information and research based on historical data or performance does not guarantee future performance or results. We just use them as an indication and then to kind of get a bigger picture and a better picture of what's happening in the economy and in the world. Okay, so what's been happening lately in the markets? I'm sure many of you have had the time or have had the interest to follow lately the news, the financial markets perhaps. Some of you may be new to trading and new to the financial markets, but you'll see and learn very quickly that somehow or another everything is very related to each other. Some cases more directly, some cases more indirectly. A few weeks ago, maybe a month ago, I did a webinar on gold and commodities. I did one on commodity currencies. So how everything is kind of tied to each other, and all this news that I'm giving you will be later tied into economic numbers and data that you can see how it's kind of been affected. Now, it's not a one-to-one correlation. It's just things tend to be tied to each other. So top news this week, we've seen the US riots. I'm sure many of you have heard, unfortunately, of the tragedy that's been happened there, and then the resulting unrest. On top of that, we've had the China tensions. Initially, it was the US accusing China of spreading the virus, mainly Trump. That turned into China passing a law in Hong Kong, taking away most of their legal rights that made them independent. That caused more controversy. But then that was overtaken by the riots in the US. We have clients and traders all over the world, investors bargain hunting as markets have been spiking lately, in the recovery. So people are looking for, okay, what could have been missed? And that's the key. Because at one point, many traders had gone into any market that was trending upwards and they were making money. But now they see it as the levels are plateauing at the moment, and that can kind of lead to a state of uncertainty. Macro data, economic upswing loses momentum. So we had seen a swing in the numbers of, for example, PMIs and indicators from different economies that were improving, and they still are, but they're losing the momentum that they had where they were improving from negative numbers and to positive. So a plus 60, for example, now it's maybe a plus 5 or plus 10, but it's still significant. In the Forex market, we have Euro USD overtook the 110 level. Could this be a rally? Now, ever since we have seen it actually continue and trade higher than that, perhaps, if I'm not mistaken, today it was around 112. And this is based on a couple of things. Perhaps I'll go into a little bit later, but mainly weakness of the dollar, strength of the euro. Oil rally loses its fundamental legs. So we had seen that oil had dropped significantly, especially WTI a few months ago went negative in the future contracts. We saw that the bounce back was quite significant and quite fast. However, that is starting to lose momentum as well because of the fact that, yes, demand for oil is increasing. I'll touch on this later, but yes, demand on oil is increasing, but we are starting to realize there are some limits to that. And on the economic calendar, the ECB decision was today, the rate decision, widely expected to not change the rates, and they did not, but I will mention what they did. So they increased the pandemic emergency bond purchase program they had by 600 billion euros. So they will be purchasing more bonds than the initial, I think, 750 billion. And then tomorrow we have the NFP report. So the non-farm payrolls from the US, very widely followed, very widely considered one of the very important indicators for the US economy, because it shows how many people claimed unemployment last month. So it's always a month before. Today we had the actual unemployment figures for this week, for the week that just finished, and that was 1.8 something million compared to the expectations of 1.8 million, to a total now of around 43 million people that have claimed unemployment from the third week of March, so from the 21st of March in the US. Moving forward, so we've had some top news, as I said. US riots have had, surprisingly, although not so surprisingly nowadays, little to no impact on the markets. So what is the difference between what we see in the news and what's happening in the markets? It's starting to widen, because we could see massive unemployment numbers and then the US 500 rallies, or we could see riots in the US and the US 100, which is the NASDAQ, approaching its all-time high again, and basically almost there. We saw US withdraws Hong Kong special status, but so we were expecting some sort of a retaliation or some sort of a condemnation, but they actually withdrew their Hong Kong special status, and no mention of withdrawing from phase 1 of the trade agreement. We also saw that the EU was going to launch a 750 billion euro package, which then got extended today with another 600 billion. European indices soared, although some of them, perhaps, if you on the YouTube video that I did last week, I mentioned that the US indices were massively outperforming lower, so Southern European indices, like the Italian and the Spanish one. We had seen that the US indices were skyrocketing while the European ones were still at depressed levels. And now the DAX is, for example, an index that actually is performing extremely well. S&P overtook the 3,000 handle. We saw, as I said, the Euro USD breaking 110, and markets expected more ECB easing, which came. But although markets were expecting 500 billion and we got 600 billion of bond purchases. And then we have the Chinese PMIs that were released early in the week, back above 50, as supply issues, which were a huge concern, are starting to fade. So hopefully everything is clear so far. And something that, as I said, people have been focusing on is what's left to trade, what's left out there that hasn't been bought out. And we'll take a look at a few stocks. We see that the US 500, so this is a monthly chart of the US 500. We can see that this is the crash in 2008, 2009, and then the rebound after. And the candles actually look quite similar. The first three, it's monthly. Except valuations on the the price to revenue of shares is actually much higher. Instead of below 1, it's above 1.5. So we can see some bargains, for example, in the industrial metal markets. So aluminum, zinc, and nickel. We can see that precious metals have been rallying, while industrial metals are still falling behind because of supply issues. So industrial metals demand is obviously lower right now, but can pick up, especially as governments stimulate economies, and construction should do reasonably well. Lower prices and COVID disruptions can impact supply. Physical assets can grow in demand amid super easy monetary policies. In essence, what this means is that at the moment, these materials that are in very high demand, usually to build things or to for manufacturing purposes, as you can imagine, as economies are closed and people are unable to go to work, they have been dropping in demand. So the expectation is, if we get back to the prior levels, these metals that are basic for certain categories of industry would also rebound. Lower prices, obviously, tend to stimulate the growth after a crisis. So that was the case to be made as well for oil. So when people were seeing that oil was dropping, some economists were saying that might actually favor the recovery going forward, because when everybody gets back on their feet, they can actually afford to use cheaper oil and perhaps could stimulate the economy faster. Another market is the Spanish index. So the IBEX 35, SPA 35 on the XTB platform, XStation 5. as I mentioned, look at the disparity between the Nasdaq and the US, or sorry, the SPA 35 and the Nasdaq. Yes, Spain was one of the highly impacted countries in Europe, but it also dropped from a similar level and it's nowhere near as recovered. While the US indices in general have had this huge recovery, even though the US became the center of the epidemic after Europe. And now we're seeing massive unrest on top of all of that. So Spain to be the major beneficiary of the European Recovery Fund, which is a fund established by the European Commission and the European Central Bank to help out the less well-off countries in Europe. Spain has also managed the critical COVID situation is actually in a better place right now than the US, as I said. Financials have weighted on the index, but with some rotation to the value, this should be less of a burden. Broader reopening still ahead of Spain. So this all means that the outlook is actually positive because we've passed, or the analysis assumes that we're past the worst, and demand will actually recover in Spain as well once the country starts reopening, and we see that the index will actually potentially recover as well. We have some stocks. So we have the largest Polish bank, Pekao Bank in Poland, at the lows, despite major recovery in indices. We can see near zero rates, negative for banks in Poland. So they're almost negative, almost zero negative rates. However, the largest bank can look into non-interest income more than the competition, Poland to be among the major beneficiaries of the RF, the recovery fund. So these countries that at the moment seem to be struggling have a way out because of the recovery fund and because of the positive outlook. And this is the theme that not everybody has recovered at the same pace. So if we go back here, we can see as the US index spikes, the Spanish one flatlines, but also has an upward move. If you can see my mouse, you can see the candles opening higher. These are dailies. Stocks, same principle. This is a stock in a country that will be beneficiary of the ERF. Another stock is Shell. So Shell, the oil company. So a lot of you might imagine that oil companies have struggled lately because of the massive drop in prices. In fact, Shell cut the dividend earlier in the year, but the yield is still 4% and remains reasonable. The stock could gain traction as oil prices recover, and the company is solid with a diversified business, could do well in the longer term. Now, a lot of companies have struggled, and especially in this situation, because they weren't able to ride the storm and sustain even after the COVID pandemic. Companies like Shell, companies like General, massive companies, they have contingency plans, and they cut the dividend, but the yield is still positive. And they're banking on the fact that because oil is still an essential resource in the long run, it's just at the moment that we're dealing with the situation until obviously renewable energy takes place. Stocks that are tied to oil, so extraction, Shell is a petroleum company, any other BP, something like that, which might have been affected negatively by the price of oil. Now, with the recovery of the price of oil, you can assume that, as I mentioned at the beginning of the presentation, tend to be correlated, even though one's a stock, one's the actual commodity, and it's all tied to supply and demand because of a pandemic. So if you just, no matter how far out you go, there's always something bigger that seems to be influencing everything. We have more stocks, equity, residential, and Macroeconomic. So US rates are still suffering badly, taking no comfort from the SPX, so the S&P 500 rally. However, expansive Fed policy can fuel the recovery because the Federal Reserve and Powell basically said we'll greenlight unlimited spending, and no matter how much we can just print money to keep the stock market inflated or propped up. And that's what the objective, he said, is at the moment, is to keep the stock market sustainable and healthy, let's say, quote unquote. However, as I said, many stocks and many indices in the US are actually banking on this. Equity residential, in April, the company owning luxury apartments got 93% rents. Situation better than expected. Maybe the luxury, one theory behind this is that the super luxury rentals haven't been as affected as the normal lower class, middle class rentals, because statistics show that the lower income you are, the less you're prepared for an emergency. And so in case where you have a month where you don't get paid, or you lose your job and 2 months down the line you can't pay rent, while if you're in a situation where you're in a luxury apartment, you're probably not in a situation where you're living month to month, and so you're not going to be needing to be cut out of your rent. This company owns retail malls. It's on the wrong side of technological change, but situation can improve with reopenings, and the stock is close to 209 lows, rallied hard afterwards. What does this mean? Basically, it means that retail malls are on the wrong side of technological change, because all indications seem to be that, especially with the pandemic, people are more likely to want to do their shopping at home. Now, some of us still like to go out, but that's not enough. The preference of a few people does not outweigh the convenience of the masses. So we'll see how that plays out. But we have seen a similar pattern in the past where something crashes and then it rallies after. So here we have some ETFs, 23 commodity futures with a good exposure to precious metals. This is the ETF. Industrial metals and energy. And we could see it drop massively. So this is tied to commodities, as I said, precious metals, industrial metals, and energy. And the weighting of the index. This is something that is a basket of different commodities instead of just trading one or another. This is 23 of them that are all tied together, that have all been suffering because of the corona. And so if we go by the logic used prior, then if the situation recovers, those commodities as well will be in demand as well, if we are in the same situation that we were before. Hello, everybody. I'm just welcoming everybody else. Thank you again for tuning in. This is midway through the presentation. If you have any questions, I'll be taking them at the end. So please, if you have any questions, just save them till the end, and I'll be happy to answer them. So let's take a look at the macroeconomic situation. So we have macroeconomic. It refers to anything that gives an indication of how the general economy is going. So could be PMIs, could be data, could be, as I show here, consumer card spending. So we saw that in March, card spending dropped massively because of the corona, but we are seeing now a recovery in card spending moving into the end of May and into June. On May 24, our tracker of Chase consumer card spending rose from minus 19.8 to minus 19.7. The tracker rose 3.3 points over the prior weekend, and it is 22.1 points above its low of minus 41 in March. So you can see it's a huge crash in the consumer spending of cards. And despite a slow recovery, we are still heading in the right direction. Here we have the Australian US Economic Activity Tracker. And we can see that massive drop, again, all of them. Although we see a faster recovery in Australia, because they apparently managed to contain the pandemic in an effective way, them and New Zealand, as well as a few other countries. While in the US, we had been seeing a potential recovery in a few places, and then the indicator starts plateauing. How this riot situation is going to affect this, it remains to be seen. But so far, the indices have still been rallying, and the unemployment figures might catch up in the end, because 43 million people accounted for since the 21st of March have declared unemployment or have claimed unemployment in the US, and those are bound to catch up. There are some positive signs, though. Mortgage applications are up year on year in the US, but overall, the broader data, credit card spending, and activity trackers suggest only a moderate recovery, even as lockdowns are being lifted. And this is kind of counterintuitive to the idea that people were expecting a V-shaped recovery. Some analysts were out there saying that perhaps we shouldn't expect a V-shaped recovery, because it's not like, okay, Corona is gone, everybody go out, immediately open up the economy, everybody's going to be comfortable flying, everybody's going to be comfortable driving. Everybody who lost their job immediately finds one. That's not how it works. So it's almost practically impossible to have a straight up. But we are seeing signs of the positive recovery in the positive direction, because of the fact that at least some businesses progressively have been opening, and some people have realized that they have to manage their expenses, whether through card debt or through other means. So China is the benchmark for the pandemic itself, because that's where we have the most data, since it started there. And because it started there, we can see how they dealt with it at the beginning and how they're coming out of it at the moment. So we can see that China's the impact on the Chinese economy. We saw a Wuhan shutdown and a huge drop in the economic activity index, and then a mild recovery. This is comparison in 2019. So we'll see that it's actually quite higher, but it's still not significantly lower. So it stopped here because they managed to shut down this very particular area with around 60 million people, and the rest of the country managed to reopen progressively fairly quickly. China shows that the initial recovery can stall. So as I mentioned, it's not that everybody goes back to work the next day. It's sectors progressively start reopening, and their supply chains have to also be available. Otherwise, you can't reopen. Obviously, China would do better with the global economy not being overwhelmed, because, as you would imagine, China exports mainly to the outside world. Many of us have products that are made in China, even though they're designed in California, or whatever they may be. At the end of the day, if nobody else is buying in the outside world, then China also is losing because of this. So it's also in their best interest for other countries to recover, and recover as fast as possible, because not only do they sell completed products, but they also sell, for example, chips to Korea for their phones and their TVs, and just more raw materials and components as well. And China is also one of the major importers of raw materials, such as industrial metals, which I just mentioned earlier in the ETF. So still, this economy that used to be growing 6% in real terms, this is the same economy that used to be growing 6% in real terms every year. The question is, will political tensions affect the business? And that's the real question, because so far, up and down, they seem to be. You have these trade disputes, and Trump talking about phase one and not adhering to it, or not. Now the newest news is that they're going to be banning commercial flights from China. We'll just have to see how it goes, because every day the situation changes. But obviously, it seems like it's in everybody's best interest to just reopen and go back to normal. But these tensions can have an impact on how fast we get back to that position. As well as, yes. So COVID data, although in some countries, perhaps even in the UK, it seems as if many areas are actually, COVID-free. That's not the case at all. In fact, we still have significant deaths even in the UK. This week has actually been the worst one so far in the world. So these are the cases, new cases outside of China. And we can see that at the peak, at the start, when everything was just starting out, we had a very low number of cases outside of China, spiking around end of March and staying around this range for all of April and into the beginning of May. And then now it's escalating. Why is that? So what happened is, and I'll mention it in the next slide as well, but it's that the pandemic epicenter shifted. So the pandemic epicenter started in China, moved into Europe, Korea and Japan, but then Europe. So then Europe had this is where Europe was suffering the most, basically. And everything was locked down in Europe. It was around March to April, and then into May, slightly, mid-May, maybe. Then we had some countries start to reopen, and now the actual epicenter of the pandemic became the US, and now has shifted into emerging market economies like Brazil. So Brazil, I don't know if many of you have been following, but has actually been struggling with the COVID pandemic, because they actually weren't prepared at all, and they just didn't close down enough effectively. And now that's pressuring their economy at the moment because of the spike in number of cases they're seeing. And we're seeing this in the data as well, even though cases in Europe have been decreasing massively. Here's an interesting chart, I think from the Financial Times. And it shows the distribution of deaths, of COVID deaths. So between March 15 and 21st, total daily deaths around 393. And you can see the distribution. So Italy was a large part of it. UK was a large part of it when the UK was the second country. The rest of Europe, the Middle East, New York itself has its own category. And then look, if you just include New York plus the US, it's almost as much as just all of Europe in this part. The UK and Italy don't compare much. Now we're seeing, though, a spike in Latin America, and the Caribbean now accounts for 40% of average global deaths. And this is a time frame. So just as I mentioned, you can see this. It's starting outside of Europe, moving into Europe. This is the peak, moving into the US then. And now we're seeing the spike in the Brazil and Latin American countries. So the US is still having large numbers. And I'd say maybe North and South America seem to be the epicenters at the moment. The pandemic is moving, Europe's looking better, and Latin America is the midst of this nightmare. And hopefully they have the resources to deal with it, as many European countries did. Hopefully everything is clear so far. Quick look at FX markets. So can EURUSD sustain the rally? We had seen that the problem now that central banks have destroyed the yield curves because they are just incessantly pumping money into the economy and buying bonds. FX pays less and less attention to the bond yields. For the euro, peripheral bonds can be more of a factor, so other bonds that are not directly tied. And Euro USD is more likely to go up if the recovery fund is implemented swiftly, so that the smaller and weaker nations in the European Union, which also have an impact on the valuation of the euro, don't collapse completely and crumble under the pressure of the massive costs that they've accumulated up until now. Now, today we got the news that the ECB increased the size of their, as I said, pandemic emergency purchase program. That's what this stands for by 600 billion euros to buy bonds. Now, many of you might be here for this topic in particular. Hopefully I referred to it enough, but this is where we're going to focus on it mainly, and it's oil. So oil markets we've seen has been one of the most volatile markets. Something unprecedented happened where the oil WTI future dropped into the negative territory last month or 2 months ago. Ever since, though, we've seen actually a decent recovery in oil with a stabilization right now. And that's what I'm going to talk about. So how far up can it go? Where do we stop? And what can happen? So we've seen some recovery in demand. However, it's not that good because, as I mentioned, it's not that everybody went back to work at the same time. So this is demand for 2020, the orange line. And you can see that it dropped massively, of course, when everybody was locked down. But as we see more countries reopen, it's slowly going to creep back up. And now it's heading back down because some companies never reopened. Some airports, if you've been following airline companies, have decided hundreds of their airplanes will actually not even take flight because there's no demand and because they would rather save the costs of doing that. Refinery products down for the second straight week in the US suggests demand could not be strong after all. So in a few months, or about a month ago, we had a problem in the US where there was an overstorage of oil, and that was also driving the prices down in addition to the no demand or the drop in demand. So we had two issues. We had the oversupply of oil. Well, three issues. We had the oversupply of oil. We had the lack of demand, which are basic economic principles. No demand and high supply equals low price usually. And then on third level, we had the massive overstocking of oil. So we had storage facilities like Cushing in the US that were basically continuing, because oil producers were still producing oil and somewhere it had to go somewhere. It was all being stored in these places, and tankers as well, they were being used. And that was the worry, that if demand doesn't recover quickly and supply stays at the same rate, we're going to run out of storage space, and we're going to have to sell this oil basically to anybody who would take it, so that we don't overwhelm our storage facilities. And the other alternative would have been to stop production, but it's actually very well known that stopping production and restarting production in oil refineries is actually a very expensive and time-consuming process. So it's actually just better to cut down production as much as you need, but keeping it running. And so once we see a recovery in demand, we might be able to see a spike in production as well to match that. But until then, I'm not sure that countries will continue to produce at the same level. And the US has been one of the countries that now has pulled back with 2 weeks straight of a drop in distillate products, even though they actually were still producing a large amount before. And this is to match the cuts from OPEC, which I will mention later. here we have the stocks of, as I mentioned, and this is not stocks as in, stocks in the stock market, but this is stocks of barrels of oil. And so while the US output declines, inventories keep rising. So I mentioned the output has been declining, but because there is no demand, the actual inventories are continuing to rise. Trump a while back mentioned he was going to buy as much oil as he could and fill up the reserves. Now that had been done. Then following, the price crashed, so he could have actually gotten a better deal. But now we're still seeing that even months later, the supply is still growing, even though demand is not recovering at the same pace. And finally, one more thing is that Russia still also has an excess of oil. So it's not in their best interest also to hold the hard ground against the other OPEC countries, especially Saudi Arabia. Markets rallying mostly on expected cuts, so it's not on, and this is the case for many other things, where it's rallying on hopes or on the, I guess, the hopes would be the best way to describe it, because if the markets hear that there might be a cut, even though demand is not recovering, that's all it takes. And then if that cut does come into existence and people actually abide by it, which is a huge issue in OPEC, where countries not abiding by the cuts they agree to, then we could see this actual number drop. So the actual stock would drop. Price resistances can cap the upside unless there's stronger demand recovery. And price resistance levels tend to be around, I think at the moment, mentioned in the last YouTube video we did last week, if you want to check it out, we mentioned that around the WTI was around 36, and for Brent it was around 40. Those were the price resistances back last week. We're still under those, but anything further than that is going to have to see some significant either cuts to supply or a stronger demand recovery. All tied into the fact that drilling activity in the US still remains very low. So initially, drilling activity had continued, but they actually, as the months progressed, continued to drop it, and it's absolutely dropping to historic levels that we haven't seen since 2016 almost. Drilling activity in the US remains very low. The number of completed wells has dropped dramatically. On the other hand, Iran, Libya, and Venezuela, Venezuela is actually one of the largest oil producers in the world, are still cutting production as well. So everybody's cutting production, and US shale, which is US WTI, is the least profitable because it costs the most to extract. So in a previous presentation I did we also mentioned the fact that different countries have different costs of extractions and different price points where the oil is profitable. So for Saudi Arabia, their cost of extraction is extremely low. So even with oil at $20 a barrel, they actually make money, and a good amount of money. Russia would have to have around $20 to $25 a barrel to break even, while the US would need around 40 to 50, 50 to 60 basically would be ideal because of the fact that US production costs so much. The United States reduced production faster than expected, even though initially they were reluctant. Then in order for the OPEC deal to happen, they took some extra cuts on behalf of Mexico. However, production was restored in some places after the price returned to $35.40 per barrel. So if the price returned, but it's not based to this level, but it's not based on actual demand increases, it's based on the hopes, then this is what we see happening. That production increases again, and then storage increases because nobody's buying it, or not as many people are buying it as the market would require. This is mainly the key, is that as soon as they saw the prices get back to a level that was acceptable for them, they started producing again without taking into account that the demand wasn't actually recovering as fast as they needed it to. Here's a chart. So there was supposed to be an OPEC meeting to discuss further cuts and agree on them next week. So it would have been on the 8th. Initially, it seemed as if this meeting was happening and oil prices actually gained on that news. After that, though, I think it was around here. So after that, though, what we saw was that it got anticipated to this week. So it was supposed to be today. But last minute, we saw a meeting between OPEC and its allies is unlikely to happen this week, as Saudi Arabia and Russia draw a hard line over quota cheating by some nations. The two leaders of OPEC told other members that talks planned for the next week could also be skipped if countries, so next week, as I said, if countries including Iraq and Nigeria don't make firm promises to implement their supply curbs. And this goes back to what I just referred to, where some countries in the OPEC bloc have trouble respecting these rules that they all agree to and the production cuts, because some countries are quite reserved about how they're declaring their the productions. So you can see that a situation where Saudi Arabia and Russia, the two main speakers for the OPEC group, cut production, but these countries don't, then they're actually just giving up parts of their market share for no reason. And these countries are benefiting, because them giving up their market share increases the price, and then them not cutting production means they can fill that gap. So that's what is at the base of the issue, is that just basic disagreements between the countries in OPEC. So they're having trouble putting that aside in order to increase the price of oil and in order to actually cope with the lack in demand. So they would rather produce more, be stern and be firm about their points, rather than actually cut production on their own end and see the prices rise because of the demand. So we'll see how that goes. I was actually hoping to be able to give you what happened in the meeting, but since it didn't happen, we're just gonna have to wait and see what happens. The initial expectation was that the cuts would be extended until the end of July, until September, if I'm not mistaken, when in fact they were until July. That itself boosted the price of oil. So as I said in the earlier slide here, well, in one of the earlier slides, I mentioned that basically just by hope of the agreement that would lift the price. But now we're seeing that as soon as the news came out that this meeting wasn't happening, the price actually, oil WTI, dropped around $1 a barrel when Bloomberg released the report. And this is all from Bloomberg, this sourced. On the daily time frame, we're going to take a look at WTI chart on the XStation platform here. So this is the gap, the lower gap. So we saw this is the beginning of the pandemic, or this is actually the oil. This is when Iran and the U.S. When the U.S. assassinated the Iranian general. This is what happened. Oil prices, and then we saw the drop, and then this is the pandemic peak, where oil prices of WTI went to the negative, and then we have seen a recovery ever since. So as you can see, most of them are green candles. There are six or seven red candles out of all of these. So it formed a kind of uptrend and an upward channel. Now, we have seen it break below, but it also on the horizontal level has broken above the highs from 11th of March. So the next place to go would be the closing of the gap. But because it's not supported by fundamental data, then that's what the tricky part is that yes, technically speaking, this is an uptrend channel, but if it's not, because it's a commodity tied to an actual supply and demand issue, can this actually continue despite and ignore all of the data and all of the negative news, despite all of that? So oil breaks through the highs of March 11, following a sell-off related to termination of an earlier OPEC agreement. So this is the sell-off, but then it broke back up. The oil price has risen sharply in anticipation of OPEC group's production cut. And then I just mentioned that it didn't happen, but it didn't actually drop that much because we're still in a range where production has been cut. However, it turns out that in May, OPEC cuts reached 77% of the intended target, mainly through Iraq and Nigeria. And so that means that 33% didn't abide by the cut. And so this is the end of the presentation, because it shows you that prices are increasing, even though the supply is increasing as well, and demand isn't increasing at the same rate. So the question I'm going to leave you with is, can these prices continue to increase despite there not being the fundamental backing for it, even though technically on the charts, it looks like it's a steady uptrend? And can the hopes of an agreement, can the hopes of further cuts boost the prices of oil moving forward? And that's what remains to be seen. So thank you very much for paying attention. Hopefully it was entertaining and interesting and informative. And if you have any questions, please let me know now, and I'll try to answer a few questions regarding this or any other financial market. So yes, if you have any further questions, please let me know. And if you can come up with any questions later down the line, please just write to your account manager, and they will be more than happy to either answer your question or give you more information. And if you'd like me to go back to any slide that you missed or that you would like a further explanation on, also you can feel free to ask that, and we'll take a few questions and then we'll go from there. In the meantime, while we wait for some questions to drop, I'll just go back through the beginning of the presentation just in case you might have missed some slides. So we covered a lot of topics today, a lot of varied topics, and I think hopefully you can see how everything kind of relates to each other in a different way, whether it's supply, whether it's the pandemic, whether it's monetary policy, fiscal policy, politics, tweets by Trump, in a way or another, they all have an influence on each other and on the prices of goods and services and of stocks and derivatives as well. So yeah, I'll just wait a few more minutes just in case anybody has a question, and then we'll just call it. Okay, well, it doesn't look like we have any questions, but if you guys have any questions that you could come up with, please feel free to message your account manager. I'm going to continue to be writing the WhatsApp messages. Some of you may know me from the WhatsApp group. If you're in it, if you're an XTB client, you can get market analysis and alerts as things are happening. Today, when, for example, the unemployment happened, the data was released, or when some sort of big moves happen. That's also part of my job. So hopefully all of you enjoyed this, and it was entertaining and interesting and informative. And I hope you have, an excellent rest of the day, and good luck with your trading. Thank you very much.